Hey, welcome to the Valutrades May 2021 webinar. Today we're going to be looking at a topic called Ask Me Anything. I'll be here with our favorite CEO, Graham Watkins.
Hi, Brad.
Hi, how are you doing, Graham?
Yeah, not too bad. Excited to be here tonight.
Yeah, excellent. It's a very, very good idea to have an open session to have traders and clients call in. Always happy to answer questions. Um, anyway, just very quickly, we've got a lot to get through, so I'll quickly introduce myself for those who don't know me. I've been doing a lot of work for Valutrades over the years. I love my favorite client, I must say. I've been doing a lot of work with obviously webinars, videos every Monday and Tuesday morning. I'm a professional and retail trader. And my job day to day is to provide content, and I do that for Valutrades. And I'm thrilled to be here and help pass on my my tips as an educator and content provider in the FX market. Graham, as I said, is the CEO of Valutrades, and if you can introduce yourself a bit, talk about yourself a bit, Graham, so the attendees can get a feel
Yeah,
for what you're about.
sure. So thanks for the intro, Brad. As you said, I'm the CEO of Valutrades. Valutrades is a FCA regulated FX and CFD broker based in the City of London. We've been in business since 2012 and focused around giving our customers the best possible trading experience across MT4, MT5, and fixed API platforms.
Brilliant, and I know from experience, and I'm not just saying this because I'm a supplier to Valutrades. Your customer service is excellent. You've got a great team behind you. There's always someone there to answer questions, whether it's on trading or deposits or withdrawals or whatever. So it's an excellent team you've got working there around the world. I'm happy to say we work in at least 4 different languages, and there's always someone there to help clients as they go, whether it's to do with trading or indicators or platform. Right, let's jump right into it then. We've got a few things to get through. And before we do that, just to let you know that CFDs and FX are leveraged products and your capital might be at risk. I encourage you highly to read the risk warnings on the Valutrades website. And if you have any questions about CFDs, leverage, please contact the customer service agents on the Valutrades website. They're always available. If you don't know what you're doing, ask us for help, and we'll help you get you going. Right, we've had this is an open session, so if anybody wants to jump on the webinar and ask a question through the chat line, we're here to help. I've got it open now. We had quite a few questions come in before the webinar from registrants and so forth. So we'll go through those quickly before we get to any live questions. I'll answer and Graham can answer as well, because we have different experiences on in the Forex business. We both work on the B2B side, and Graham has worked more on the brokerage side. So we've seen the business from all angles. One of the questions that I get asked quite a lot by students is, what products do you like to trade? Well, if you're a beginning trader, my first answer is stick with the basics. Stick with the Forex, the US majors, gold and oil, and maybe some of the indices. You can then branch out into other products. We're getting asked quite a bit these days about cryptocurrencies, and we'll talk about that a little later. I can have strong opinions on that topic. I don't trade crypto myself. A lot of people do. I find Forex to be much safer, much more predictable, and much more fun to trade. The volatility is there. It's just enough to help you make some money. The volatility on crypto right now is a bit crazy. So if you're a beginning trader, I would highly recommend that you stick to the US majors, perhaps, and gold and oil, and maybe some indices if you're keen on trading the stock market. I know, Graham, your customer service agents probably get asked this a lot. How do they respond to what products would you like to trade?
Yeah, so I think that's sort of a misconception in a trader's mind what they would like to trade. That's a popular question we get asked, but I think the question should be more, what products do I think I can make money in the most? Because you don't have to enjoy it. It doesn't have to be your favorite thing. What you're looking for is something you can trade that suits your risk appetite and your trading strategy. So for example, you mentioned cryptos. Well, if you want to be plus minus your entire account balance in 5 minutes, and you're going to stare at the screen and look for excitement, that might be the thing for you. If you're looking to sort of day trade, take small swings, but you've got a day job and you can't focus on the screen all day, you might want to pick something like Eurodollar, where you know the movements are going to be smoother, and you know if you place a stop loss in the market, you'll get filled at your rate and not after a big gap in the market because Elon Musk has tweeted something. So I think people just need to focus on, products that they understand. Are you trading something that you understand? Products that suit their trading time horizon. So if you're scalping in short term, you want tight spreads. If you're trading, a long-term trader, you might want something where the overnight financing is beneficial for holding your position. And then I think that probably leads into the same conclusion you had, that for most people, at least to start with, that would be the major pairs like Eurodollar, dollar yen, pound dollar, combined with some of the indices like the Dow Jones, the Nasdaq, etc. And I'd even say that approaching gold or oil does bring a bit more volatility, and therefore you do need eyes on it a bit more even to start trading those products.
Exactly. Yeah, you reminded me of a few things. If you're for a new trader, it might be a bit difficult, but if you get involved in scalping, you definitely want to stick to pairs with high liquidity and low spreads, like euro dollar, dollar yen, and so forth. If you want to scalp something like Kiwi CAD, it can be difficult because the spreads are higher. It's definitely a viable pair to trade if you're trading swing trading or day trading. But if you're scalping, then you want to stick to those with low spreads. Yeah, gold is always fun to trade. And there's something else too, is that as you get going in your trading career, and I've found this, you may find that certain pairs don't work for you, and then a few months later you find that you're back in love with them again. So you need to be flexible. I mean, for the first literally a couple of years of my career, I was having bad luck with Aussie, just for all Aussie pairs for whatever reason. And then I think for about a year, I was almost trading exclusively Aussie because it just was working for me. I know some traders who strictly trade one pair. I knew a guy who traded pound yen for years and years on the 4 hour. That's all he did, and he got to know that pair intimately. It's one of those things. And the gold market, as you mentioned, Graham, can be great to trade, but in times of a bit of geopolitical risk like we have right now, we've had some problems in the Middle East, and we had some interesting problems the other day or yesterday in Belarus, and the gold market. Investors pile in for safe haven vehicles like that, and gold goes up. It can be a bit volatile if you're not paying attention to the news or you don't have your stop loss set correctly. So it's as we say in the UK, it's horses for courses. You need to be able to find the pairs that work for you and markets that you understand. And Valutrades, I must say, has a very good selection of pairs to trade, and the right pairs to keep you safe.
Yeah,
so looking
absolutely.
at yeah, right. And a similar question that has come in: should I focus on one instrument or trade many of them? I know I touched on this briefly, and I had some students asking me this very recently because they were sort of going in the shotgun method and trying to trade everything, and they found they were getting confused. And fortunately, on their own, they said, let's pare it down a bit. And I had one guy who just said, I'm not trading indices anymore. It's just not working for me. And he's actually made some good trades on pairs like on pound yen and so forth. So he's managing to stick back. He's coming right back to the Forex pairs, and for now avoiding pairs like oil and indices that aren't working for him. He may go back to them. I mean, I know some traders who strictly trade WTI and Brent, and maybe gold, and they avoid Forex pairs. But one of the things that we get involved with trading psychology is not to get involved in too many pairs. And again, it relates back to the first question. Get to know what the market's doing in one area. It can just save you a lot of time and hassle. And again, I'll make as an example, if you want to trade strictly Aussie pairs, absolutely great. You may want to trade them all. One thing I would say though is a mistake that a lot of beginning traders make. In fact, if you caught my video today, I was looking at quite a few different Aussie pairs. I know I mentioned Aussie quite a bit. It doesn't help you to go short on Aussie on every single pair, because if you pile in on too many trades in the same direction on one currency, you're actually going well beyond your risk limit. So you need to be careful with that as well. Any thoughts on that, Graham, about pairs that how many pairs you like to trade at a time?
So I mean, me personally, I don't get much free time to trade these days. But I have the lovely privilege of sort of seeing what thousands of our clients are up to, sometimes speaking to some of them directly. And I would go as far to say that I cannot think of a single client that is manually clicking the button to execute their trades, trading in more than one pair or one group of pairs like Aussie or Kiwi or Sterling, that is actually successful doing it. I think there are plenty of people that can have a EA or robot trading strategy that might have automated a scalping method. Now, if that robot is good, there's no reason why they can't apply that to 10 different markets and it trades them all very well. Equally, you might have someone that has a strategy around trading news. And so in that case, someone might be able to trade euro dollar when non-farm payrolls is coming out, WTI when oil inventory is coming out, and Aussie if the Australian central bank is doing interest. But if someone is sat there and sort of trying to day trade the market, I don't think I've ever seen any upside to them trying to trade 2, 3, 4 different pairs, because ultimately I think it just leads to, for every upside you have in more opportunity, you have downside in not being able to manage your positions well, know what's coming in the market. So you end up with situations where you get twice as many opportunities, but that one news event that you didn't know was coming is going to wipe you out. Whereas those that go, you know what, I'm going to do my homework, whether it's euro dollar or dollar yen for me, I'll do my homework, I'll research that pair, like you say, get a bit of a feeling or knowledge for it. Very easy to then stay up to date with the economic news that will affect that. Seems to me to be a much sort of more successful cohort of our clients that are focused down into one or very small amounts of things to trade.
Exactly. And one of the things that I found, excuse me, over the years, and I made the mistake many years ago of trading too many pairs, is that you suddenly realize you're setting up competitive trades. For example, if I go long dollar yen and long Aussie dollar, I've actually got one trade against the American dollar and one trade going with the American dollar. So you sometimes don't realize you're actually doing that, and you find out that, hey, one trade's looking good and the other trade isn't. Why is that? Well, it's your own fault, because you've actually gone in opposite directions on the same currency. And of course, the American dollar, is the linchpin of the Forex business in the world.
You think you're getting double the exposure, but actually you're just paying double spread, double brokerage.
Exactly. Yeah.
By in essence having offsetting positions that you could have achieved by trading one cross pair. Lot less exposure, lot less position, same resultant P&L.
Yeah, exactly. And if you're trading indices, you're very often better off just trading one at a time. Unless you're trading something like the Hong Kong and the DAX, which can be a bit different. I mean, lately, I'll be honest with you, I've actually trading a lot on the NASDAQ because for some reason, the last few months, it's actually lagging behind the S&P and the Dow Jones. So it's actually become an easy trade. But if I trade one at a time, I don't go and trade all of them, because what you end up doing is setting up yourself for, if you're risking 1% per trade on each trade, and then suddenly you're trading 5 indices, and suddenly then it's the same trade times 5, so it doesn't work. It just sets you up for for an unbalanced risk position. So yeah, and the answer is, should I focus on one instrument? Maybe not just one, but don't go into the shotgun method and trade everything under the sun, because your risk is a problem. You end up creating competitive trades on certain currencies, and it can just be frustrating to keep track of everything. So in the beginning, especially, try and stick to a few pairs. I mean, we say the rule of thumb is to trade 1% per trade in terms of risk. We also say don't risk more than 5% of your account on all your trades that are open at the same time. So that'll give you a clue as to how many that you should be trading.
Absolutely.
Okay, let's take a look. What indicators do you recommend? Well, I personally like using the stochastic oscillator, but I do a lot of work, and if you follow my videos, especially on the Tuesday videos, I'm always drawing lines, and I don't just draw lines for the videos. I'm always drawing lines on charts, support, resistance, chart patterns, double tops, double bottoms, pennants, ascending triangles, etc. So those are my indicators. And the indicator that I like the best, as I said, I'm always telling people, is the stochastic oscillator. I spent years trading Bollinger Bands, still valid, and they're definitely worthwhile. But in terms of day-to-day trading, I try to trade mostly with chart patterns and the stochastic oscillator. I do dabble. In fact, I was teaching a class today, and I got a trader looking at the parabolic SAR. In fact, we did a webinar on that a few months ago, and there's some interesting characteristics with different indicators like MACD, parabolic SAR, that may not help you in individual trades day to day, but they can give you a good feel for certain trends. So one of the problems that a lot of traders get is they put way too many indicators on a chart and just get confused.
My very first teacher told me the exact same thing. He insisted we have some Fibonacci retracement lines, an RSI if we really insisted, and he'd fire us on the spot if we had anything else on our charts.
Right.
And I think as time went by, I understood that it was less that he was saying that the Fibonacci retracement was right, and more he was just saying, well, better you pick something and stick to a regimented regime around it than you throw on any one of 100 indicators that suits your mindset or your way out and just use them to justify your position. So I think all indicators will have some validity. I also think there are times that, if the US central bank comes out and says that they're going to raise interest rates, the market will move based on that fact alone. And any indicator you have is not necessarily going to predict that, and certainly isn't going to stop the market moving because of it. So I think the key when people are looking for indicators is find something that works for them, whether it's a short-term indicator or, if they're trading long-term, something like a 200-day moving average. And then most importantly, once you've settled on something that you think suits your strategy, stick to it fairly rigidly. Don't change the time period on the indicator or switch out to another one just because you woke up that morning and really wanted to buy dollar yen, because then all you're doing is curve fitting those indicators to a trade that might not be sound in the first place.
Exactly. There's no point in tweaking anything to fit a trade. The trade has to come to you. You can't go to the trade. Actually, you brought up a good point, and I've had different colleagues and students and so forth trade different. I mean, I've got a good friend of mine who's a professional trader in the States, and all he trades is basically Gartley patterns, and he makes fun of people who trade moving average crosses. I was at a seminar of the Society for Technical Analysts in London, and well, when it was before COVID, and I had a presenter who just lived and breathed moving average crosses. So it all depends on what you do. What I've found over the years is that if your trading strategy is more aggressive, then a certain set of indicators work for you. If your trading strategy is more conservative, then you're looking at a different set. And I'll give you an easy example. A lot of beginning traders start with something like the moving average cross. And as you say, you can tweak those moving averages until the cows come home. I find that a good rule of thumb, if you're using moving average cross, is to have the slow one set 1/10 of the fast one, or vice versa. So maybe 10 and 40 on the moving averages, and something like the MACD to confirm. So, and there's just two indicators right there with that piling on. So if you want to trade moving average crosses, I think most people on this webinar know what I'm talking about. It's a conservative strategy because the moving averages don't cross until the trend is well into its life cycle, and then maybe confirmed by the MACD or even stochastics. Even more conservative way to trade is with parabolic SAR, even combined with moving averages. So that's a valid way to trade. For me personally, I find that it takes too long to get into that. If you're a scalper, you might want to try Bollinger Bands and stochastic oscillator, because they will give you good signals if the market is ranging properly on the 1 minute and 5 minute chart. So it all depends. And you mentioned Fibonacci. I mean, I very often look at Fibonacci, and again, you see the videos on Tuesday mornings on technical analysis. Sometimes Fibonacci just doesn't work. I mean, you can plot it, and there are many ways to try and plot Fibonacci, but if you try and, as you say, cheat and make it fit, you're not fooling the market, you're just fooling yourself. Sometimes Fibonacci will fit perfectly into a pair on the 4-hour daily chart, or even shorter time frames, and if it works, then great, keep at it. Add an oscillator to that. Again, you can add an oscillator like MACD or the stochastics to Fibonacci, because Fibonacci is really support and resistance. That's the indicator.
As well, a good way to sort of look at indicators is sometimes you don't necessarily want to base your trading off them, but you can do the opposite and use them as a fantastic example of where not to trade. You'd see a lot of people when trading, we see with our client base, there'd be good traders, they generally make money, but they still have a tendency to overtrade. So, you might have a very simple philosophy that I'm coming in, I'm looking at a Eurodollar chart, it's been in a 5-day uptrend, I don't want to stay in the way of that trend. So in effect, your initial trading strategy is just to buy with the trend, and you don't need any indicators for that. But you can then start using things like the moving averages, like support and resistance levels, to go, okay, if I'm buying with the trend, I'm not going to buy leading into resistance, I'll buy when the resistance breaks. So you're not directly taking that indicator as your signal to trade. You're doing something much more fundamental for your trading, and then just essentially enhancing or protecting yourself with some indicators on top of that to, stop a bad entry or exit, manage your risk. And I think people that can do that also will tend to do better than, anyone who's looking for the silver bullet of, I apply one indicator, I trade off it the whole time, and I'm going to make money all the time. Generally, you need a bit of finesse and use them as help more than the holy grail.
Exactly. I mean, I was helping someone recently who said, "Oh, I was told to use the MACD," and I said, "Yeah, there's 3 ways to use MACD indicator and MT4." And I showed them what they were, and I said, to be honest, it's not my cup of tea, and it does nicely show you how strong a trend is, but then again, I can look at the candles and tell you how strong the trend is. I mean, I'm quite happy to, not use that. It's, some people live by it, some people don't want to use it, some people, some people just trade naked charts. I mean, someone asked me what indicator couldn't you live without? I said, well, the horizontal line. You can put any indicator you want on a chart, but if you don't have a sight on support and resistance, forget it. And then after that, then the trend line. So that is where, and I'll go through that in a second, that is where you want to start before you start piling on indicators. Again, I'm going to repeat myself: support, resistance, and trend lines, and then look at the indicators.
Yeah.
Okay. Another question we get, right, getting into trading psychology. How can I overcome losses, and what can I learn from these losses? Well, very quickly, if you want to be a successful trader, you have to be able to accept losses. And you're going to hear, I'm sure Graham will say the same thing that I did. If you have a proper risk reward ratio and proper risk management, you can manage your losses. It's that simple. I mean, I had I'm going to jump ahead here. What can I learn from these losses? Well, I tell students to create a journal, and I said, you need to be documenting every trade you make. Sounds boring, and you wouldn't see too many crypto traders doing, not just clicking buttons. But if you want to become serious about trading indices, gold, oil, or Forex, it would be to your benefit to create a journal and a trading plan. And I just saw literally on the weekend, someone sent me their journal, and it was simply a paragraph written about what he traded, why he traded it, and the activity during that day. And the first item was I traded this and I made a profit of X. And the next three paragraphs were this didn't work out, and basically there were three of them. But if you looked at the first paragraph, his profit on that trade was still way more than the three that he lost and I said, look at this journal. You've actually documented something really, really important. You've actually written down why you succeeded, why you failed. But look at the most important thing is that your profit on this one trade was way higher than the sum of the other three trades that you lost. This is exactly what you need to do. So how can I learn from these losses? You just simply write them down, find out where you made the mistakes. A lot of times with new traders, it's things like, and you mentioned it earlier, Graham, it's impatience. You jump into a trade without actually realizing that you're maybe too close to, you're buying too close to resistance, or you're selling too close to support, and you don't find this out until it's too late. So, and the thing we talk about, the risk reward ratio of being something like 2 to 1, and some professional traders like to trade 1.2 to 1, so a very narrow risk reward ratio. And as long as you can stick to it and not be moving your stop loss or setting your stop losses too tight, your losses can be managed. So it's
I think the key is not necessarily that there's a problem to take losses. Every good trader will take losses, depending on a particular trader's risk reward ratio. Some can take more losses than profits if they're smaller. The thing that undoes the vast majority of traders is failure to manage those losses, which generally, and unfortunately, we see all too often, will generally be a bit of a snowball. That what happens is a trader will say have a 10 pip stop loss is his default rule. He gets into a trade, he puts that. He gets particularly unlucky. Market moves very fast against one of his trades. Before he gets his stop loss in, he's taken, a 12 pip loss. Then what he should do is just go, that's unfortunate. That was quick. That happens. Revert to plan. Instead, he'll say in the next trade, well, since the last one was a 12-point loss, I'll throw out my 10 pip profit target. I need 12 to make it back. Then on that one, when he ends up 10 offside, he says, well, I lost 12 on the last one, I'll lose 12 again. And then, by the end of the day, he's averaging a bad trade 5 times and has run his collective loss 100 pips against him and wiped his account out. And it sounds really simple with us talking here, but it's amazing, and it never ceases to amaze me how many people can find themselves in a little black hole where everything falls apart, and when it does, it happens a lot quicker than they think. So, you know, if you're running tight risk management, you've been in the game for weeks on end, you're starting to make money, and then in the space of a day, you know, you lose half your account value. And losing half your account value in a day is nothing to do with being a good or a bad trader. It's the fact that clearly your risk management has been thrown out the window, because if it hadn't, you shouldn't be able to take such a loss on one day versus the profits you've been making on other days. So like you said, some people find it really handy to write it down. I think that whether you write it down or not, you should have loss management planned out before you start trading, and then just really stick to it. You know, whether your rule is to take a couple of losses and stop for a day, or a particular amount of pips per trade or per day, whatever it is, define it before the loss comes, and that'll make dealing with the losses a lot easier.
Exactly. Stick to your plan. I mean, one of the things that we hear over the years is the term revenge trading, and you alluded to it, where you think, okay, well, I'm going to get, I know better than the market. I'm going to get it even. So you ramp up your position size to get even with the market, and as you say, you end up blowing up your account because the market doesn't care about your account. Years ago, I heard a professional trader tell me, he says, if we lost 5% of our account in one day, we were sent home and weren't allowed to trade for 24 hours. On the other side of the coin, if we made 5% of our account in one day profit, we were sent home and weren't allowed to trade for 24 hours. Because one of the things that I've found, and I'm sure you've heard the story as well. Somebody opens up a trading account, they don't know what they're doing, and they say, "Hey, I doubled my money, I tripled my money in 1 week," and then a few days later, I lost it all. Ha ha ha. Well, what that means is that they got lucky with gambling, thought they knew what they were doing, and then blew up their account subsequently. Years ago, I had some friends who were the life coaches, someone who not a psychologist, but someone who consults with people about things in their life. And I was having coffee with her once, and she said to me, she said, "Believe it or not, most of my clients are traders. And their biggest problem, 80% of the people who come to me, is because they get cocky. They get overconfident and they end up losing money because they're doing so well one day. They get cocky, overconfident, and they lose their profit or go back into massive drawdown the next day. So it's a roller coaster ride, and you need to maintain, as you said, stick to your plan, maintain risk management, and be cool. And I've heard professional traders use the phrase revenge trading. Even seasoned guys who, or girls and guys who seem to know what they're doing. And we all fall. I mean, fortunately, I haven't fallen victim to that for some time, but I have followed the rule where if I have a very good day, I will simply turn off the computer and go for a walk, because I know I can, give my profits back to the market quite quickly. So
Yeah.
it's not just about overcoming losses. It's also about making a lot of money quickly and then losing it. So
Yeah, definitely easy to do.
right. Next question. And this very common. Do you recommend technical or fundamental analysis? And well, it's a matter close to my heart. If you watch my videos, my Monday video is about fundamental analysis, and my Tuesday video is about technical analysis. The easy answer is both. But again, I know a group of people who live and breathe fundamental analysis, and they make fun of technical. I also know guys who say, I ignore the news, I don't want to know about fundamentals, and I purely trade technical. Again, getting back to what you trade and how you trade and your lifestyle and your the pairs you're trading and the time frames, it's totally up to you. You'll find that most people will say both. And I have a definite rule of thumb on which way I go. And I tell everyone, and I was even telling someone today, before you do that, check the calendar. And I was on screen with him saying, let's take a look and see what's coming up. I mean, something happened to the pound today. The pound went totally crazy, and we couldn't find out why. And eventually I found out is because Ursula von der Leyen decided she didn't like the UK's proposal for the next Northern Ireland agreement, and the pound dropped. That's a fundamental event that you didn't see coming. and you're not going to be able to plan for it, but you can actually take advantage of that fundamental event after the fact. And we did. We actually got involved in a couple of pound trades, counter trends. So you can use fundamental events to help you. You can use fundamental events to avoid trading if you're interested. But what I tell people is there's no point, and you mentioned it earlier, Graham, there's no point in jumping into technical analysis if the fundamentals aren't there, especially with the economic calendar. And sometimes the fundamentals can be right in front of you simply by making a profile of all the dollar pairs or all the pound pairs or all the yen pairs and just seeing if it's strong or weak. That's also, it's technical analysis of your chart, but it's also a fundamental to find out which pairs are strong and which ones are weak. And I had someone recently, I said, look, I want you to look at all the different pairs and tell me which ones are strong and which ones are weak. And he came back to me, he says, well, looks like, and this is weeks ago, he says, looks like the euro is the weakest right now, the weakest currency, and the CAD is the strongest. And I said, well, then take a look at your euro CAD chart. And it was a straight line. He traded a pullback on it and went short and made money. So there are ways you're doing fundamental analysis and technical analysis at the same time. But again, I'm going to repeat myself. Don't jump into technical analysis unless you know what the fundamentals are. And if you're just getting involved in trading right now, you're actually in a good time, because I must say, during the 4 years, and I don't mean to get political, during the 4 years of the Trump administration, technical analysis was almost out the window. And Graham mentioned earlier about a tweet coming from the White House or tweet coming from wherever, which would completely destroy your trade and just surprise you with fundamental events that you just didn't know were happening. Now we're more under control. There are no tweets to destroy your trade, but it's all about fundamental analysis. I'm sure, Graham, you have some thoughts on this as well.
I mean, I think that you can't ignore the fundamentals. You know, some people like technical, some like fundamental, some like both. But I just think you can sometimes get away without looking at technical analysis or using your approach to it. But at the end of the day, if something fundamental like a geopolitical event, an interest rate event comes out, that will be the lead driver of the market. And I just don't think you can ignore that. And like you say, people who look at technicals will essentially pick it up in other ways. But to me, I think if you want to be a trader, you are sort of obliged to know the basic fundamentals first. I don't think you can call yourself a trader unless you know when the Federal Reserve is meeting for their interest rates, or if you've got CNN on in the background for when the next bomb is going off. So I think as a beginning trader getting involved, your first stop is, have I got basic access to fundamental news and a basic grasp of what this is going to do to the products I trade? Then if you want to branch out and go more technical than fundamental overall, no problem. But you've got a very sound basic understanding of fundamentals that should stop you getting sort of blindsided by anything coming through the market.
Exactly. I remember asking a guy years ago, do you ever trade the news? He was a professional trader, and he says, yeah, by accident. Haha. We just did a video, and it's on the Valutrades YouTube page and on the website as well, on news trading. And it's a classic example of what Graham was just saying. And here it basically shows how you can use fundamental events combined with technical analysis to trade. And I go on and on about the counter trend move. So hypothetically, if let's say euro dollar is trending down, an important news event has driven price up, you will typically be driving price back into a bank's automatic order, which is typically a line of support or resistance or a trend line. And in theory, unless that news is really, really off the mark, that fundamental event will drive your price back into a situation where you can get back into the market. And it's my, to be honest, as a professional trader, that's my bread and butter trade. I will wake up at 3 o'clock in the morning and trade the New Zealand dairy product report just to do that, and it very often works for me. So that's where I use it, technical and fundamental in combination. I've actually made what I call an order of analysis. And I tell people this over and over again. The fundamentals, as Graham said, are fundamental. You need to be aware of, if New Zealand retail sales came out with a really, really bad number that was way off the mark of analyst expectations, and this could carry on for 3 days, then you definitely be not, you either don't want to trade that or you want to get involved and ignore the technicals. So you have to be aware of the fundamentals first. And things like, I mean, gold, if you're trading gold, you absolutely have to know what's going on all over the world with gold. I mean, I've had, and everyone's had the most amazing things happen to gold. Based on an oil tanker gets seized in the Gulf of Hormuz, or an earthquake in Japan, or whatever. And these things can either screw up your trade or give you a great opportunity. So you really need to know what's going on. I mean, speaking of oil, fundamental events on oil can really affect the Canadian dollar. So, I've had some birthday presents where I've been trading the Canadian dollar. Something happened to the oil market and the Canadian dollar has gone in the right direction for me. Thank you very much. Take my profit. And I've had it the other way around. So you really need to be aware of the fundamental events as they go on. Right. I look at the fundamentals, then I look at support and resistance. That is, if you're not aware of support and resistance on every chart on the time frames you trade, you're not trading. Then I look at chart patterns. And if you watch my videos on Tuesdays, you'll see this is all I'm doing. And I'm not just drawing these lines for the sake of the video. That's the job. If you're a trader and you're trading chart patterns, which hopefully you are, you should be doing these lines all the time: support, resistance, and chart patterns. And then indicators. I mean, as we talked about earlier, Graham, just jumping into an indicator really isn't going to help you. And I think this is an important list I've made. I've got indicators as number 4 on my list of priority when I'm analyzing a market. And then I look at candle patterns. Candle patterns can be a very effective way of confirming when a reversal is coming, or whatever. So I know some traders who put candle patterns on the top. I think they're wrong, but if it works for them, then that's great. So I hope that this list that I've made is valuable. Fundamental, look at the support and resistance, then chart patterns, and then indicators, and then perhaps candle patterns.
Yeah, and I think what you're saying, Brad, is sort of get those all lined up. That doesn't mean that you're going to have, let's say, 5 trades on the go because each of those gave you a trade. It's more you're going to have one really good trade on the go where you've got some fundamentals backing up your idea. You're around the right support and resistance area. There's some chart patterns. Maybe you can get an indicator or a candle pattern, and then you enter that trade. So, it's a lot of analysis for some quality trading. It's not a lot of analysis to find a lot of trading opportunities.
Exactly. Yeah, and I've had more than one people say to me, says, I don't need to make this trade. I'm not confident with it. I can wait till tomorrow. And that's a very healthy professional attitude. I mean, I was looking at something today with a guy, and he says, oh, I really want to go short. I forget what the pair was, to be honest. And I said to him, I said, look, you look at your chart and look at the fundamentals. The only positive thing on that chart is the stochastic oscillator. You don't want to make the trade based on one oscillator, because everything else is not helping you. You need to get your ducks in a row. And as we talked earlier, you don't need to pile on tons of indicators onto a chart, but you do need to stick to the basics.
Yeah, absolutely.
Okay. Here's another magical question, which you as a broker get all the time about crypto. In fact, I'll let you go first on this one, Graham.
Yeah. So yeah, this is definitely a hot question. We're getting all the time now. What do you think of crypto? Do you trade crypto? How do I trade crypto? It is absolutely front and center of a lot of clients' minds.
Yeah.
What's really interesting, to share some insight from the sort of brokerage community, though, is we currently don't offer crypto trading because we get asked a lot. One of my first port of calls is to friends and colleagues that work in other brokers, and I say, hey, are you trading crypto? What are your clients doing? And interestingly, any broker I know that has added crypto is only seeing it as like a long only buy and hold investment, which is very, very different to what our average customer is trading, how they're trading, and what we're trying to do. So most of sort of our customers and our successful customers are aiming to regularly trade on price movements, whether that's scalping within a day, whether that's swing trading. They're still looking to pick a move in the market. Whereas the people I hear are trading crypto are buying it, sticking in a wallet, hodling it, and that's all they're doing. So it's a very different thing at the moment in my mind. If you want to believe that Bitcoin is going to trade 100,000, then you can buy some and put it in your back pocket, and that's fine. But I don't think that's trading. That's investing, or
Exactly.
at a stretch picking a very, very long-term trade. Now, if you think that you're going to trade Bitcoin intraday, or swing trade it or something like that, the numbers just don't make sense. When we've looked at the market, the spread is so wide. So if you trade euro dollar, you're paying away in spread 0.0000% of your investment. In crypto, particularly some of the more exotic ones, your trade and you'll pay 1% of your trade value just in executing the trade and paying the spread.
Yeah.
So then you're fighting an uphill battle to win what's quite a large amount of your trade that you just lost in spread back. If you're trying to hold it overnight, you're going to get interest rates of 5 to 10% cost of holding. So actually, if you're trying to do any form of short-term trading on crypto, the odds are so massively stacked against you, that it really just doesn't make sense. And then that's on top of, if you go to a unregulated exchange, are your orders getting executed at the correct price? Is your deposit safe? So I think what Valutrades as a business has decided is that it's a very interesting product. We're going to keep our eyes glued to it, see what's going on, and if it becomes tradable in the sense that it is regulated, there are a lot of liquidity providers, spread and execution costs narrow, then at that point we'd happily be offering it beside euro dollar and dollar yen as a currency pair to trade. But I just don't think the market is developed for that now, and it seems that its current use case is more as an investment than a trading instrument.
Yeah, there are a lot of exchanges and brokers who are offering crypto, and it's almost gambling because you just don't know which way it's going. I mean, I had someone ask me some months ago, what are the fundamentals on Bitcoin? And I said, well, I don't know. What did Tyler Winklevoss have for breakfast this morning? Well, I mean, lately the fundamentals on Bitcoin are what is Elon Musk tweeting? So you're getting back into a situation where you can throw technical analysis out the window because instruments like Bitcoin and Dogecoin are being driven more by Elon Musk than they are by market forces, and it all gets back to liquidity. I mean, it's very difficult to predict anything in a market that's very illiquid, as you would know very well. It's much easier with Forex when you've got literally trillions going through the market every day, whereas on the crypto, you're not even sure what it is you're trading these days. And the thing as well is that, and it's a bit of a misnomer, cryptocurrency. Well, it's really not a currency, is it? Because who's actually using one of these cryptos to buy anything? I know there are a few that are doing it, but the thing is, until it's a chicken and egg, because until you can use, let's say, Bitcoin or Dogecoin or Ether to actually transact, you'll have volatility, and of course, no one's going to accept it while there's volatility. So it's a bit of a chicken and egg.
Yeah, I think there's two really key points there. One, if you can have Tesla buying 1 billion of Bitcoin and that moves the market 10%, that's not a liquid market. If you've got
Yeah,
the
exactly.
US
Yeah.
Federal Reserve trying to control the dollar price, they've got to buy trillions before they can control that market. So one, do you really want to be trading a market that any one person can manipulate? And unless you, well, I guess you do want to be trading it if you know how they're manipulating it, but
Yeah.
otherwise,
Yeah.
you want to stay well clear of something that someone can control and you're not privy to that information. um and then two, what you're saying about it not being a currency, um I think that's true as well. Someone posted some research I was reading this morning that was like, Bitcoin is a great hedge because if the US devalues the dollar and we get hyperinflation, Bitcoin's the perfect hedge. Whereas actually, the way I see it trading, it's the exact opposite. If you have inflation because the US government is printing money, everyone's buying Bitcoin and it's inflating with everything else. And if you have like a sort of a blow up situation and a crash, Bitcoin is the first thing to crash. If it's a hedge to those bad situations, then it should be very stable. Or it should move inverse to most other things, like we usually see with gold in times of panic. But actually, Bitcoin seems very far away from a gold correlation, and very close to something like a Nasdaq or Dow Jones correlation. And so at that point, I'd rather just go trade the indices that move in a very similar way, but much more predictable, much more liquid. Trade them with hundreds of very safe brokers seems like a better option to me.
Exactly. I mean, the recent thing, if someone asked me, is Elon Musk manipulating the market? I said, well, I don't think so, because he's actually saying stuff that's driving his investment down. Um, I mean, if he drove he drove the value of Bitcoin down, then bought a whole load of it, that would be manipulating the market, but he didn't do that. And the irony is that I think is that Elon Musk said he didn't like it anymore because it wasn't environmentally friendly. Well, we knew that years ago. I mean, come on. um, the truth is, and I did a bit of digging, is that he said that people could buy Teslas with Bitcoin, and as it turned out, it was actually too complicated to do it, and he was actually confusing customers by it. So that's the real reason that he decided he didn't like Bitcoin anymore. So it's all a bit of a farce, and I personally try to avoid trading stuff like that because I just don't know what it's going to do tomorrow, and who's going, as you say, who's going to drive that market tomorrow. So, and I can understand why Valutrades and many brokers don't offer crypto vehicles or cryptocurrencies, as we call them, at all. So stick to Forex, stick to the indices, stick to gold. You have a lot more fun and manage your risk a lot easier.
Yeah.
Okay, another question we have. I'm a new trader. Can I get some advice on a good strategy? Well, again, I'm an educator as well, and what I do, I teach students about the five things that I showed you earlier on a slide. Is that looking at the fundamentals, support and resistance, chart patterns, and indicators. So what's interesting is that I've teaching over the years. Some people can really get an easy handle on finding things like chart patterns and reading indicators. And I've had guys and girls who are whizzes at charts, and they can understand how to zip around MT4 and put indicators on, but they can't draw a line. You really need to be able to do this, and it just takes time. So can I get some advice on a good strategy? It all depends on what kind of trader you want to be. Do you want to be a scalper? Do you want to trade the 4-hour charts? Are you doing intraday swing trading? There are a myriad good strategies out there, and there's also a myriad bad strategies out there. I can honestly say to people, if you're just getting started in trading, follow the videos on the Valutrades website and the YouTube channel, and learn about support and resistance and chart patterns. and risk management. That is the best strategy that I can recommend right now. Any thoughts on that, Graham? You guys deal with the customers every day.
Yes. Unfortunately, I have to put my regulatory hat on and say that Valutrades is regulated to be an execution-only broker. So we can't strictly offer clients advice, although lots
Yep.
of them ask. And so in a more general sense, I would just say, pick the strategy or find the place that's going to teach you the strategy that's right for you. And just please stay away from anything you see in the market that looks like a get rich quick scheme. The advert on Instagram that says, register here and within 30 minutes I'll make you $1,000 kind of trading strategies don't work. If it was that easy to make money, someone wouldn't be selling it on Instagram. So when you're picking a strategy, it's going to be hard work. You're going to have to probably go for a few of them, do some research, read some good books, take your time, and pick something that is kind of correlated by a lot of credible sources. Do not go for the get rich quick strategy.
Exactly. That's what I tell people as well. This is not a get rich quick scheme. This is not gambling. I mean, I've worked as a professional trader, and if my investor sees us do 1% per month, they're over the moon. I also trade with a Malaysian fund as well, and they want to see more like 3 or 4%. So we're not talking triple your money in 1 month or 1 week. We're talking slow, progressive trades here. So you don't need to be jumping into, as you say, get rid. I mean, we in the business and even as traders, we get bombarded with silly emails, with these robots that will get you rich quick. All I can say to you if you're looking for a new strategy, go back, watch the videos on the Valutrades website about, again, I'm going to repeat myself, support, resistance, chart patterns, simple indicators, and just backtest, and you'll get a feel for how to trade the instruments you want to trade.
Yep. So do we
Okay,
have one last question, Brad?
yeah,
I
there's
know.
one last question that came in, and this is one for you. What payment methods are available from Valutrades?
Oh wow. So yeah, this is more an operational or customer support question. But believe it or not, is one of the most commonly asked things. So definitely, as part of the step to becoming a live trader and getting started, you need to send some funds to your account at Valutrades, where we segregate them in a client money account, and that provides you with the margin to trade. There are many methods that clients will be able to send funds to us, very dependent on where that client is based. So we have regular bank transfers, we have Visa and MasterCard that are common in the UK, are common in Europe. Then we have like a huge selection of e-wallets. So some of the ones we know in the UK are Skrill and Nicotella. For Far East Asia, we have StickPay, FasaPay, and then we have some local payment methods. So specifically local bank payments in China, Southeast Asia, Latin America. But really, whatever the method is, if you're not sure, you should just contact the Valutrades customer support team. They're very friendly. They're available 24 hours. Just ask them how do you fund your account, and they see what your circumstances are and guide you through that process.
Very good. And one of the things I've noticed over the years with Valutrades is that you have an excellent client area. And I'm not just saying that because I'm on the webinar with Graham today. They really do. The client area is superb, and it makes it quite clear the options that are available to deposit funds and withdrawal. Hopefully, you're withdrawing your profits, but it's all there. And again, I repeat, the best client area of any broker that I work with.
And I think sort of the Valutrades ethos has always been to sort of, take the stress away from the customer, give them the best service, the best technology we can so they can focus on trading. We don't want a customer that's frustrated because they can't get through to us or they can't withdraw their profits. We want a customer that can trade uninterrupted and focus on trading, which is a really hard thing to do, and let the admin be sort of as frictionless as possible. So
Exactly.
hopefully we're achieving that. And one of the reasons for this webinar was to get people to, maybe if they haven't spoke to me before, to hear my voice, see my face. And anytime any customer has any questions, not only can they come to the customer support team, they can find our operations team, they can even find me. I'm there on social media. I will pick up the occasional live chat. If anyone wants to sort of explore anything we've discussed today, or just really anything about trading, it's a pleasure for me to be able to engage with the clients directly.
Excellent. Yeah, and as I said earlier, on any part of the world and any language, the Valutrades website has the chat area available. And there's almost always someone there to chat with you and help you out. Anyway, that's great, Graham. Thanks for your time. I've enjoyed this, and I hope it's been valuable for the attendees. Again, if you have any questions, just pop them on the chat line. You can even ask me questions directly through the YouTube channel, because I do the videos every week. So you may not be seeing Graham every time we have a webinar. You'll be seeing me, and hopefully you'll see me every Monday and Tuesday morning on the Market Blast. Well, guys, thank you very much for attending, and we'll see you soon with our next webinar.
Cheers, everyone. Thank you very much.